Bob Michael's here. You want to get in on the action of this conversation? He's like, why did I even come here this morning? By the way, Bob is the Chief Investment Officer and Head of Global Fixed Income, Currency and Commodities Group at JPMorgan Asset Management, where he oversees, you ready for this, $800 billion, folks. That's a lot of money.
It is a lot of money.
So where do you think we are in this cycle?
You started at over $1 trillion, but no.
No, we're almost $1 trillion.
Yeah.
I'm going to be the professional optimist today and say we're in a pretty good place. The U.S. economy is gliding into year-end in a pretty good environment right now. Corporate America seems to have absorbed the tariffs pretty well. The consumer's doing pretty well. We do expect the Fed to come in and cut rates in December. That would be a nice tailwind as we head into 2026. And the One Big Beautiful Bill Act hits.
All right. Okay, here's a timing question, though. And I've been talking all the morning about this study that I looked at, a chart, actually came out of JPMorgan, one of your analysts had put together, showing if you put money into the market at, I think it was 23 or 24 times price to earnings ratio. Historically, 10 years later, you'd look back and you'd say that you only were really benefiting in terms of I think it was up 2% on an annualized basis, your return, or down 2%. It was somewhere in the, it was one of those scatter graph charts. Have you ever seen those?
Yeah, the scattergrams.
Yeah, so the question is where we are right now in the cycle. If you were to put money in the market today, whether in an index or something else, and then you and I were to go and have breakfast together in a decade from now.
I think you're going to look pretty good. I think you have to appreciate that there are some secular changes underway. Technology, of course, is a big one. You have to look at demographics. The 1991 births are now the largest demographic. They're 34 years old. They're dominating earning, spending, and saving. You've got, I think, a pretty stimulative macro environment. On the fiscal side, pretty much every government is borrowing and spending. And in the U.S., you've got easing central bank accommodation and probably some regulatory tailwinds as well.
So we've got NVIDIA coming up this week. That seems to be like, the thing everybody's focused on. Would you be doubling down on the Mag 7 or the Mag 10 or whatever you want to call it, or would you be doing something else?
Tough question, but I think you have to look at where the money's going. And right now, every company we talk to, and we extend a lot of credit into the system, everyone's gearing up for CapEx next year. Right. They're looking to ramp up some hiring. They're looking to build out whatever they're doing in AI. They see the effectiveness of it. They want to spend in that area. And of course, they're going to spend at the biggest producers in that space.
Do you worry about the credit issues that you said extending credit into the market and given the CapEx spending? There is a question about CapEx spending and whether it's actually too much in this space, given the economics of the folks who ultimately are going to have to pay for it?
I think this is one instance where you can look back at the dot-com era and recognize that a lot of money will be spent in areas that will be fruitless, and a lot of money will be spent in areas that will bear fruit.
Right. But so what's the lesson, though, of the we go back to 1990, 7, 8, 9. What is the lesson of what an investor is supposed to be doing if that is the corollary?
The lesson of the dot-com is there was a bubble, it burst. We don't think we're in one now for AI, but companies didn't stop spending on Wi-Fi, the internet, and technology. Can you imagine if every company out there said, I told you so. Look at stock valuations. They're down. I'm not going to invest in this. It's a hoax. Ridiculous.
Okay. Bob, I want to thank you for coming in this morning.
Always a pleasure.
Appreciate it.